Thank you.
This meeting is being recorded.
Okay, sure. Yeah. So in the last couple of sessions, we've looked at trends. We talked about the trend toward automation, the trend towards decentralized manufacturing, where companies produce products based on comparative advantage, distributing capacity around the world to produce various component parts and then assembling them somewhere else, like the iPhone, which is a prime example of decentralized manufacturing. We've talked about jobs that have been lost to automation, decentralized manufacturing over the course of the last 35 years. We certainly looked at that trend in the United States. One of the points that came out was the trend towards economic nationalism, and what it was that I meant by that. Economic nationalism is more or less a mercantilist view of international trade. It was the prevailing school of economic theory for the better part of 300 years between 1500 and 1800. And what it held was that, a static view, essentially that trade is a zero-sum game. I imagine that sounds not unlike the former president who saw trade, I think one could argue convincingly, as a zero-sum game, with an effort to overwhelmingly favor exports and domestic industries to the complete exclusion of opportunities that one might derive from international trade, and willing to use all sorts of ineffective trade tools like tariffs and other non-tariff barriers that can be very destructive in order to achieve those objectives. And so that's what I meant by economic nationalism. I think that the example that I use with regard to the US paying for security for NATO countries, I think was not necessarily the best example, and I wanted to clean that up. If there are any questions on that, please come back to me. Or feel free to bring it up now. Someone else came back to me with a comment about Mario Draghi, which was very interesting because it came out last week on Wednesday. Mario Draghi, who was the former head of the European Central Bank, he's been asked to become the premier of Italy. He was asked by the president of Italy to become the premier, and in fact, he enjoys overwhelming support in Italy. The question was whether or not I support him, and I didn't want to come back with too quick an answer. My recollection of the euro crisis is that the European Central Bank waited much too long to get into the mix, unlike the U.S. Federal Reserve, which was very quick to act under President Obama, well, specifically the Federal Reserve under Chairwoman Janet Yellen. And that the ECB was particularly slow. I know that Mario Draghi gets a lot of credit for the ultimate salvation of Italy, but as I said, the arrival of the aid was too late. Was ultimately good, but it took too long. That being said, he's very well respected throughout Europe, in the European Central Bank, and throughout Italy. And therefore, I wish him well, and therefore would support him in the absence of any other suitable candidates. That's my response on Mario Draghi. I'd like to go to our shared screen now, if I could, and pull up tonight's lesson. I'd like to return for a few minutes to the oil markets, if we could. Yeah. So here we are back again in the oil markets.
The oil markets went up so much recently because
they did. The oil markets were up today.
Yes, I sold today my 100 shares, not that much, but I should wait it. I was waiting until, when was it at the time? Until lunchtime, because that's what I professor realized during the day. If you wake up in the morning, it's obviously it's a pre-market before. But the pre-market, I don't have that much capital, then I don't see the prices. But I was waiting. I was like, I am happy whatever I make. And I could double my money because afternoon, the prices went like $1.50, but for my 100
since you've gotten us started there.
Yes.
Patricia, why don't you let us know? Tell us, why did the prices go up? What's going on in the oil markets? One of your classmates brought it up last week. If you want to identify yourself as the person that brought it up about OPEC Plus and Russia, I'd love to hear from you. But can you tell us right now, Patricia, what was it?
That's what I am thinking. The fuel is going up because the world generally from the COVID is a little bit recovering and opening up, and that's what the fuel is coming
Part
up.
of it, the opening up of the economy.
Yeah, we consuming more fuel. That's why the fuel is coming back more expensive. Like I am writing as well the paper for other class, what is accounting class, and I chose to write the paper about the Delta. Then Delta during the COVID, why the tickets was so cheap, because the fuel was so cheap and they could still afford it. Obviously, they have so much losses, but
Okay.
the fuel was so cheap, that's why they didn't have that much losses what could have when the fuel will be like regular prices by the
So
barrel.
your point is
Yes,
that when fuel prices are cheap, the losses that airlines experience during a time
yes.
of economic contraction is less than it would be, of course, when oil prices are higher. That's true. Thank you for your comment. I wanted to get back to the point that was brought up last week. In fact, OPEC Plus, the membership of OPEC Plus is listed here on the right. These countries from Azerbaijan down to Sudan, as you see, it includes Russia, has been in place since 2017. The objective here has been to help weak markets and to coordinate production schedules between the OPEC membership, the countries which we identified last week here on the left, and the OPEC Plus countries that are official members to OPEC, but are coordinating with them since 2017. Can someone tell us what happened last week with oil production and OPEC Plus countries? Okay, well, what happened last week was that Saudi Arabia agreed to cut production by 1 million barrels a day, which is a significant number. Already, global production is down about 6.5%. Well, it's down. 2020 global production, as you can see here, is down about 6.5%, 94 million barrels a day and change, as opposed to about 101 million barrels per day in 2019, as a result of the demand contraction due to the pandemic.
Professor, from which sources you taking this data?
This is from the International Energy IEA, International Energy Administration. IEA. This is from OPEC.
Okay.
Okay. So,
question, if I can.
please,
How did the shutdown of the Keystone pipeline contribute to the oil prices?
To what extent does the cancellation of the Keystone pipeline contribute to the oil prices? That's a very good question. That's a very good question. And I'm going to say not much. Because the fact is that the Keystone oil pipeline provides excess oil that we don't need. Okay, it was always seen as being a boondoggle for oil companies at the great risk to average citizens, because the Keystone oil pipeline travels through major water sources like the Ogallala Aquifer, which touches, I think, 14 states and provides drinking water for millions of people. There have been persistent leaks on the Keystone pipeline since it's been activated. And so I know that it's just been canceled on the Biden administration. I think that's a great reference point. I do think, though, that in this case, in terms of the oil prices, I think that we're looking at a combination of two things. I think we're looking at, as Patricia pointed out, the anticipation of return to demand, successful vaccine rollout around the world, and also the change in production coming out of Saudi Arabia last week, which is going to sets a, the less you produce, that provides a floor for prices. The less they produce, that provides a floor for prices. At the same time, they said that Russia and Kazakhstan can increase their production by 500,000 barrels a day. So in other words, Saudi Arabia holds steady, the other members of OPEC Plus hold steady, and a couple of members may increase some in order to generate what? They need more income. They want more money, right? And for Saudi Arabia, it's a way to create goodwill. It's willing to give up some of its revenue to support the other members in OPEC Plus. Because what is Saudi Arabia facing? It's facing obsolescence for the one product that it's been relying upon for generations, which is oil. And so they're not in the business of creating new opportunities now as much as in the business of maintaining the market share that they have. And they need all the help that they can get. If you look at 2014, we looked at Brent crude and WTI oil prices. What's happening here in 2014? We saw the collapse of oil prices. Does anybody remember? I know it's a couple of years ago, but does anybody remember? Saudi Arabia was dumping oil. Why were they dumping oil? Because they want to drive American shale oil producers out of business. American shale oil producers are the biggest threat that Saudi Arabian Saudi Arabia Aramco faces. And so, as you point out here, to push oil below $40 a barrel, that's the point, was to drive American shale oil drillers out of business. Did it drive American shale oil drillers out of business? Yes, some. What did we see mostly, though, with regard to rig counts? We saw that rig counts contracted substantially. Did they kill the U.S. shale oil drilling business? Anybody?
No, they started using.
They did not. It was not a successful strategy. They need other options. They need to develop other options in their toolkit in order to maintain their market share and maintain a price level that all of their members can survive on. So that was a bit of a failed endeavor. Nevertheless, you see the coordinated action last week and the expectation of a return to demand, lifting oil markets. Today, as we see, we closed at $60 and $58 a barrel in the Brent and WTI markets, respectively. And that's, of course, a positive for oil producers. As you know, though, looking at this chart, though, they're all longing for the days when the prices were well over 100. So this is well below where they want to be, but likely indicative of the trend that will continue south over the coming years as we focus more and more of our energy on renewable energies and the decarbonization of the energy markets. That was all I wanted to bring up about the oil markets. But again, thank you for the point about OPEC Plus. They are a relevant factor in the oil markets. Russia is certainly a member, and it's something that we need to be aware of. So thank you for bringing that to our attention. I'm just looking at my notes here from.
Professor,
Oh, sorry.
Today,
What?
Professor, as of today, how much is the barrel of oil of the market? Is not $15?
No, the
barrel,
$60 a barrel of oil. It's $60
Yes.
a barrel, $58 a barrel. That's the price.
Okay.
Okay. So I was very
question.
impressed. Yeah, sure. Do you pronounce your
Wendy?
name Guy?
Yeah.
It could be Guy.
No, it's Guy. I've been told that. Yes, it's Guy. When the U.S. started using fracking?
When did the U.S. start using fracking? I would say in the early 2000s, the early aughts. Yep.
And then not until, I would say, the last few years, they didn't have the most of the market, right?
They didn't, but slowly. I mean, the U.S. achieved oil independence a couple of years ago. We looked at that last week. Slowly, the market has been growing, over the last, the last decade exponentially, to the point that we have become competitive in the global oil markets and the global gas markets, acting as a counterweight to Russia, certainly in Western Europe, in the gas markets, and providing us, as we talked about last week, a strategic advantage in negotiations with the oil producing countries, and allowing us to have less dependence on the Middle East, which has been a thorn in America's side for many, many years. At the same time that public opinion and the acceleration of climate change is accelerating a transition to all renewable energy. I mean, look at it. You're seeing, it's extraordinary what's happening right now, where you see countries like General Motors who are announcing that they are going to transition away from carbon-based fuel cars over the course of the next 15 years. That's extraordinary. Not unlike today, we saw Elon Musk buy $1.5 billion worth of Bitcoin. What is the significance of Elon Musk's purchase? Anybody?
I think that Elon Musk just created an arbitrage, because once he bought a Bitcoin, Tesla share went up by 2%, which is more than $1.5 billion. So I just think it plays with the market a little bit. Okay,
that's someone.
Yes,
Sahar argues that he's playing with the market, creating perhaps an arbitrage opportunity. I'm not. I like the articulation. I'm not so sure I totally agree. Does anyone else have another thought?
Yes. Okay.
Okay, so if he props up the price of Bitcoin, which soared to I think 44,000 today or so and change, if he props up the price, that's going to keep the price elevated for Tesla. Yes. Right. Okay. Right. Okay. Very well. Very well.
Yes, I agree totally, Andrew,
I
with
think
you.
that's
And
excellent. I think that's very well put,
yeah,
Andrew. Thank you. Very well said. Does anybody believe that, um, uh, in light of the fact that other major companies have also put big bets on Bitcoin, that there is some argument that could be made that the endorsement is because, like companies that are embracing green energy and renewable energy, like General Motors, a modern company like Tesla wants to embrace what it believes is the future of transactions, which is a cashless future, and that
Yeah,
virtual currency is here to stay. I mean, is there some argument to that? And that he has the money and the gravitas, he has the public profile in order to make a big splash.
I'm not quite as contrarian as my peers, but I agree with you, Professor. I think he just may see a genuine value in this for himself, for his shareholders, and for the cryptocurrency market. I mean, you have institutional money managers around the nation that are propping up desks, crypto trading desks. You have IBM's
So in other words, what you're saying is
endeavors
serious
recently
money.
failed. I'm sorry.
Institutional serious money has found its way into virtual currency, and therefore this could just be part of all of that trend.
Yeah, I
That was
think
very
that
well said.
institutional money
yeah, okay.
I think that institutional money it speaks to some validity of this asset class, if you will.
Well, I agree with you 100% on
Also,
that point, and I thank you for your comment. Um,
Luis, and totally, I agree with Andrew what he was saying before. But yes, cryptocurrency is the future, in generally speaking. But me personally, I just don't believe in Bitcoin because it's something up in the air. And today you can say is worth it that much money, and tomorrow can be worth it $1. Then we talking about like even money, the paper, and the paper we agree $1 is $1, we agree $100 is $100, and we stay with this. And even like gold, we believe
okay.
in that. The cryptocurrency for me is something like up in the air, up in the cloud, and I never know what I
Well,
can
then we're not going to
expect.
call you we're not going to call you an early adopter. You will definitely not be among the early adopters.
Professor,
That being said, though, there were people that thought that the innovation of cars would be short-lived, and other advances in the industrial age. I'm not
Professor,
so sure I agree with you. Yeah, please.
but isn't it true that currencies overall need to be reflective of a country's assets, and that's why you have inflation and deflation overall. When you have more money in circulation that your country is worth, then you have inflation. But what about Bitcoin? Like,
You know what?
to
I
what
don't want
assets
to.
is
I don't want to
Bitcoin?
spend too much. I don't want to spend too much time getting distracted by Bitcoin. I understand that there is an argument that there's a big bubble in the Bitcoin market. Um, I alluded to it because I wanted to draw your attention to the emergence of this trend, which is virtual currency, and the fact that a major player in corporate America, Tesla, is now endorsing this transaction mechanism, like other major corporations, and as you pointed out, institutional players as well, which ascribes a good deal of significance to the very concept. And so I don't want to get too bogged down on that right now. So I'd like to move ahead. I was very impressed. I read through some of the comments last week. I know that people, there's a chat that goes on. And I was very impressed with some of the comments. I see that some of you are very sophisticated about the markets, and I thought that was just great to see that. That being said, there was a question about whether or not we're going to talk about delta and theta, which is a measurement of risk on price changes on options. When we get to options, we will talk about delta and theta, but not for the moment. Let's move off of the oil markets. Let's look at the January jobs report, the report that came out on Friday. So the report was not good. The report was actually pretty meager. Unemployment fell from 6.7% to 6.3%, but overall job growth was pretty pathetic. What happened? Can anyone tell us?
I think analysts were expecting greater job growth, and there wasn't. It was pretty, like you said, it was pretty meager. In fact, there was job losses in leisure industries such as hospitality and those sort of industries, and that's really what's decreasing the overall figure here.
We saw job losses at the end of the year is what we saw. We saw job losses at the end of the year. We saw overall hours worked fall by about 10% for the year. We saw some pretty sobering numbers come out last Friday. And in fact, those numbers, which are pretty negative, provided a bit of helium for Joe Biden's rescue package. Why? Because the weaker the numbers are, the more the argument one can make that we need a strong rescue package in order to stimulate demand and support the economy. In terms of the low employment rate, the lower unemployment rate from 6.7 to 6.3, well, that's a positive, but one needs to remember, we need to remember, I'm going to point out to you that a good deal of that reduction is because of people that have checked out permanently from the job market because of discouraged efforts to find a job during a period when we're about 10 million jobs below where we were at our peak at the beginning of the COVID in terms of overall labor market here in the United States. If you look at the non-farm payroll numbers here, you see that, again, in March and April, we shed about 22 million jobs. We've recovered about 12.5 million, so the balance of 9 or so million jobs that still have yet to be filled. As I'm going along with these, with this discussion of the jobs report on Friday, which was so critical, if there are any questions, let's please jump in. Again,
Professor, I do
wanted to
have a
ask
question.
I wanted to ask about the people working part-time, because I feel like even though some people didn't lose their jobs, a lot of people are working part-time.
And are they captured in the labor? Are they captured? That's a good question.
Yeah, that's what I'm trying to asking, because some of them are even working less than 20 hours.
They are. I am jumping right now over here because I actually lost my job during the COVID, and yes, right now, since I declare my unemployment, you can declare how many hours did you work, and you still can get support from the government. Like if you work like, let's see, 5, 10, 15.
Okay, I don't want to get too off the track about that. Yeah.
Then you still totally fine.
Okay.
Professor?
Yeah. There are alternative measures of underutilization. We're going to go through those that take into consideration part-time workers. One of you brought up an interesting point last week. Why aren't farms included in the payroll survey? It's important. I wanted to address that. Farms just simply fall out of the scope of the payroll survey, and it's been that way since the Bureau of Labor Statistics has been collecting statistics since 1950. In 1950, we were in the middle of the Industrial Revolution, and what the Bureau of Labor Statistics was focused on was the manufacturing sector, not on the farming sector. The need for more accurate employment estimates in the farming sector became, over the years, the purview of the Department of Agriculture, which today tracks non-farm farm labor. As you can imagine, farm labor has contracted dramatically over the course of the last 100 years. In 1930, about 24% of the workforce worked in farming, agriculture, and now it's less than 2% of the labor force works in agriculture.
Professor, what was that figure in 1930?
In 1930, 24% of the workforce worked in farming and agriculture farming. And agriculture output represented approximately 8% of US economic output. Today, that number is 2% of the labor force and less than 1% of national economic output. That isn't to say that there isn't billions of dollars of GDP tied up in agriculture, and that soybean farmers didn't suffer enormously under trade war, along with other farmers whose products were prevented from entry into foreign markets that slapped on retaliatory tariffs.
Professor, I think that's one of the reasons the United States have so much deficit in their budget.
You mean so much in our annual budget deficit or in our trade deficit?
On the trade deficit, because there is nobody that want to work in agriculture sector, so they need to import all those materials from China and India and all other countries.
Well, they're not importing it. They're not. The only thing they're really bringing in is undocumented labor, which represents about a third of the farm labor workforce. But it's more difficult to track. And according to the Department of Agriculture, the lack of agriculture in the payroll survey is almost certainly inconsequential for the statistics that I just gave you now. What we're focused on now are the non-farm payrolls, in terms of which represents, the majority of the workforce in this country. In terms of the tools that are being used on farms around the country, well, those tools are imported from around the world. The labor, though, that you're talking about is migrant labor that comes in every year and plays an indispensable role in the farming of our agricultural products and other such things. Yeah. Well, we just got started in the semester, and we're going to spend the first couple of weeks talking about the capital markets. We get to a baseline where I'm comfortable you understand basic economic indicators, basic measures like present value and some other things we're going to work on. And then we're going to work in the chapters, and you're going to have an exam. You'll have everything is done concurrently. But right now, the first few sessions focus exclusively on the capital markets. We're going to segue into globalization, which is chapter 1, then on to economic theory. And by the time we roll around to the midterm in March, we'll have covered a lot of territory, and the exam is structured as true, false, and multiple choice. And I assure you it's going to be just perfect. Throughout the lectures, we're going to talk about current events, and those current events in class and international trade include how the international markets are going. U.S. is a bellwether for markets around the world. How its economy is performing is an important barometer for the rest of the global economy, and something that we're going to keep our eye on in varying degree throughout the semester. As I said, getting off last week and into the next week or so, we're going to continue to talk about the capital markets. And today we're going to focus on the Federal Reserve and what its role is and what the tools are that it can use to enact monetary policy. Is that okay? Well, the economic events will be with us throughout the entire semester. I don't see how we can conduct a class in international trade and finance without looking at what the markets are like. We look at a bit more granular detail here in the United States, for example, in the labor markets and such, specifically because of the outsized role and profound influence of the U.S. Economy. And so we move on to non-farm payrolls. We look at the overall labor force, again, emblematic of the uninterrupted job market growth we saw following the collapse of the Great Recession, all the way until we see the pandemic-driven economic collapse that drove 22 million people out of work. We've made some recovery, but obviously we have got a ways to go. And the labor market data that came out on Friday only confirms that the economy is continuing to struggle and remains in distress, which is why you need a significant rescue package and continued support from the Federal Reserve. Now here we're looking at
about that.
Sorry?
Can I ask you a question about the jobs and the stimulus money? Isn't there a fear that if I mean, first of all, the job number, shouldn't that be compared to the percentage of the economy that's actually open? Because like if certain things are closed or at a capped capacity, like obviously those jobs aren't going to be given back to the people who filled them because they're not available. And the stimulus will just further to go to like corporate, Amazon, Costco, those kind of places instead of the small businesses if they're not even open.
There's not there that's there's not evidence of that. Their evidence is that most of the money, there are incidents where money went to parties that maybe were less deserving than others, but the fact is that employees all over the country, citizens all over the country got their stimulus checks. I know plenty of people who did, and were the better for it. We know that there are millions of people who can't pay their rent, who can't put food on their table, and those stimulus checks are critically important. It's in some cases a matter of life or death, of being homeless and not being homeless. And the U.S. government is amply able to borrow money at ridiculously low rates. And during times of economic distress, there's only one thing the government can do is print money. Print money, stimulate the economy, create expectations of inflation. People will start buying, businesses will start spending, and you incentivize virtuous cycles of growth. That's the only solution. Austerity is not a solution to a downturn in economic activity. We've learned that over and over again, that austerity is not a solution. We learned it in the 1930s. We learned it in the early 2000s. We learned it in 2008, and we're learning it now again. Pick any recession at any time, and austerity doesn't work. So,
Professor, I'm sorry. Professor, if the government print more money, this is not affecting the GPT of the country. I thought is weakening the dollar, is weakening the value of the money when you're printing them too much.
well, you might think so, that a country that runs big deficits is going to suffer. Its currency is going to suffer, and yet the U.S. runs big deficits, and it's with impunity. And one of the reasons it runs big deficits with impunity is why? Because the US dollar is the reserve currency around the world. And so mercantilists believe, economic nationalists believe that trade is a zero-sum game, that we should only maintain trade surpluses. But trade surpluses are only possible in the short run. They're not possible in the long run, especially if your currency is the global reserve currency. Because what happens? You sell more stuff, and that bids up the price of your gold, that bids up the price of your currency. Yes? Inevitably, your trade surplus is going to be erased, and it becomes a trade deficit because of the strength of your currency. And again, the U.S. is able to run deficits year in and year out with impunity and maintain a strong dollar, just the way the U.S. Government is able to enact aggressive monetary and fiscal policy action without the negative side effect of hyperinflation that has been predicted over and over again each time one political party is arguing for tremendous government support, and another political party says austerity at all costs, whether it's here in the US or in the example I'm thinking of in Western Europe. So what we're looking at now are the
Professor,
various, excuse me?
I got a question for you. Do you think that the unemployment rate will remain flat as long as Biden plans to raise the minimum wage are still on table? Because I think that
raising the minimum wage is a critical step in undoing some of the really terrible income inequality in this country. A wage that hasn't been risen since 2009. I don't want to really spend too much time today speaking about the minimum wage. We'll get back to it. In terms of the unemployment rate, I expect is going to remain reasonably high over the course of the next 5 to 8 years until we're fully back to where we were. It's going to take a while. Well, unemployment, the Phillips curve says that there is a non-accelerating inflation rate of unemployment, that there's NAIRU, and that there is a stabilizing rate of inflation that equates to full employment. And that rate, according to the Fed, is what? That's right, between 2 and 3%. In terms of tackling the Phillips curve right now, I just want to leave that aside for the moment, not get into NAIRU. let's just focus on this right now. I'd like to get through this here. So these are the 6 different types of unemployment, going from basic unemployment, people who are unemployed 15 weeks or longer, to include people with temporary jobs, plus discouraged workers, marginally attached workers, and people who are employed part-time for economic reasons, as one of you pointed out. The broadest measure of unemployment in our economy is the U6 measure, which has been as high as 20% during the Great Recession. Now you see it's at 11.1% in January versus where it was a year ago at 6.9%. A year ago, we were at 50-year lows on unemployment at 3.6%. Now we're at 6.3%. The expectation is that that's going to take a good number of years to recover. U3 is the official unemployment rate. And as we pointed out in the BNet class, these numbers all were released on Friday, and I wanted to make sure that you got to see them. Okay, any questions here? You look at the chart of the various measures of employment underutilization, and you see that since the mid-1990s, 35 years ago, 25, 26 years ago, that they follow one another, U1 through U6, with varying degrees based upon the level of attachment workers are in the measure. Here we see the growth in the labor force between 1990 and 2020, just about 2021. And again, we see the consistent growth of the economy, the labor force that contracted in each one of these recessions. We have the savings and loan crisis here, the dot-com crash, the Great Recession. And here we see the greatest crash with no modern precedent, which is the pandemic recession. Now here you see in 2008 through 2010, a loss of about 9 million jobs as a result of the Great Recession, where we were hemorrhaging 800,000 jobs a month. We thought that was huge. Now you're talking about 20 million jobs a month in 2020. Those 9 million or so jobs that we lost in the Great Recession were more than recovered, and what you see was a post-war record, a period of uninterrupted employment growth between the end of the recession in 2010 all the way through to the beginning of the pandemic in March of 2020. Any questions, comments here? This is meant to be illustrative.
Professor.
Here, let's talk about the labor force participation rate. It's an important measure, one that we will go back to over again throughout the semester. It measures the active portion of the economy's workforce that's employed or actively seeking employment. Obviously, as workers become discouraged and stop looking for employment, the rate decreases. The highest LFPR ever recorded was 1998 at 67.2. In 1998, what was going on in 1998 in the U.S. economy? What was the big thing?
Dot-com.
Dot-com.
Dot-com. That was the
beginning of the dot-com until 2002.
1998 was the big thing. That was before the dot-com bubble in the early 2000s. That was a very exciting time. It was when Jeff Bezos was starting out and everything was getting underway. The question here is the all-time high of 67.2 versus the LFPR now of 61.4. Can anyone account for the difference? Why is it lower now? Aside from the pandemic recession, the Great Recession, what else?
Technology took most of the jobs.
Right, the pandemic took most of the jobs. That's right. So you've got
not currently now, but I'm talking this downtrend because technology became more used in businesses.
So you're talking about the trend towards automation and mechanization. So you need fewer and fewer workers, and so that, along with in other words, global trends, decentralized manufacturing, automation, nanotechnology, that in combination with the impact of the Great Recession, the impact of the pandemic recession, this has all led to a contraction of the labor force participation rate. I think that you're absolutely right. I think it also includes a lot of people who are returning to college after the Great Recession, also returning to college now. And a a lot of baby boomers that are retiring, people in their late 50s into their early 60s that are retiring now. One of the things that we've seen here in the United States is that recovery lags in non-metro areas versus rural areas. The rural areas, what we see is that since the bottom of the recession, you see metropolitan areas up here have more than recovered from their pre-recession levels, yes, in 2008. But what you see is that employment in non-metro areas still remains below pre-recession levels. What's the reason for that? What happens in a country like the United States where you see more and more people aggregating around big cities? Yes, you develop.
Yes, they moved to the suburb.
You develop these dense cluster economies, right? To the detriment of what? Everything else. To the detriment of the rural communities, to the detriment of the peripheral economies that don't do as well. So that areas, small markets can become deindustrialized with areas that are rural, that are peripheral to the economic core. Okay, that's one of the things that we've seen. This graph doesn't take into account the pandemic crisis, and naturally, the effect on rural areas has been dramatic, much like it has been on metropolitan areas, but obviously much greater among rural areas. Now, let's turn our attention, talk about the yield curve. We've made our way through the employment report on Friday. I'd like to turn our attention to the yield curve and get down where we are with the Fed, what their role is and what the tools are that they can use to address downturns in the economy or incidents of inflationary pressure. So what we're looking at now is the yield curve, which just shows us the relationship with duration here and interest rates, right? Known as the term structure of interest rates. And we know that a normal yield curve, you're going to see greater demand at the end of the curve. You're going to see a greater reward at the end of the curve, which means what? If you lend the government money for a longer period of time, what are you demanding? You're demanding a higher interest rate. That's why the yield curve looks that way. If I lend money, if I buy treasury bills for a 6-month treasury bill, I'll accept a lower rate of interest than I would if I bought a 30-year treasury bond. Okay? So the greater the duration, the greater the premium that is required, the greater the liquidity spread that is required. Okay? As we go through this, if there are any questions, shout it out. So we talk about perceived risk.
Yes, Professor. I think so. The bonds, they are very secure to invest. But if you want to really
Pardon me?
I think so. The bonds, treasury bonds, they very secure to make some money, very secure to invest. But if you really want to make the money, you don't invest in the bonds. You invest in something what is moving on and up. Then you have to be current with the news. You have to be current with the economics. You have to be current what is happening on the market. And that's,
we're talking about the yield curve right now. But right now, I want to talk about the yield curve.
Okay.
I want to focus on the yield curve. Okay. So here we look at the yield curve. One of the common measures of risk is the spread between the 2 and the 10-year. So here, what do we see? We see that in the beginning of 2020, the spread between the 2 and the 10-year was 30 basis points, 1.88% versus 158. It was 30 basis points. Typically, the spread is about 100 basis points. The lower the spread usually equates to a lower perceived risk. Now here, what's happening? This was Friday's number. On Friday, we saw that the spread between the 2-year and the 10-year was 110 basis points. Well, there are two things that are happening. The curve is steepening. Why would the curve be steepening? Does anybody know? We haven't talked about steep yield curves, but there might be some people in there that know what that is.
Expectations of inflation?
Maybe because the Fed is buying only short-term bonds right now?
Well, I don't think that that's the case. I think that they're buying across the yield curve. Certainly, they're looking to increase the keep the rates low on the long end of the curve, and therefore they'd be buying on the long end of the curve. I think two things are happening. I think that there is an expectation of a massive stimulus package that's going to drive economic growth, and therefore there is an expectation of a quick recovery. And ultimately, down the road, there will be that will become a source of inflationary pressure, as you pointed out. That's very good. The other condition that we're seeing here is well, we're seeing both of those conditions, excuse me. We're seeing the growth in, we're seeing the growing expectation that there'll be a massive stimulus package, and along with it, ultimately, a rescue of the economy. And over the longer term, there will be inflation that will require the Federal Reserve to come in and raise rates. So typically, we see a steepening yield curve when an economy is in recovery. There's also a growing concern, though, about whether or not there will be success with the vaccine rollout, and that's one of the aspects of widening yield curves. Is a greater spread between the 2 and the 10-year is the growing concern that the vaccine rollout may not be successful. So if we look here, we look at the 2 and 10-year spread, then we look at the TED spread. The TED spread is the difference between 3-month LIBOR and 3-month Treasury. 3-month LIBOR, what is LIBOR? LIBOR is the London Interbank Offered Rate. It's the standard lending rate in the UK, and it's a standard lending rate. It's a standard rate in the global interest rate markets. Many mortgages and credit cards, student loans are tied to LIBOR. It's a benchmark loan rate. As many of you may know, London Interbank LIBOR has proven to be susceptible to manipulation.
It's the rate that
It's going to be replaced at the end of 2021 by SOFR, which is the secured overnight funding rate. It's more or less like LIBOR, but it's supposed to be stronger and less susceptible to manipulation than LIBOR, which for the past 35 years has been the global standard for interest rates. And so LIBOR, like key US rates like prime rate and the Fed funds rate and discount rate, is considered a benchmark rate. And so we consider the risk between risk-free treasuries and global corporate credit markets, which is the LIBOR markets. Typically, it's about 50 basis points. During times of extreme stress, like we saw in 2008, that number widens to hundreds of basis points. Right now, it's at 16 basis points. As you can see here, 3-month LIBOR is at 19 basis points, and 3-month Treasury is at 3 basis points, so your spread is 16 basis points. Okay, are there any questions here? Okay, good.
What was the name of what will
You have the TED
Yeah.
spread, and the side. Oh, it's SOFR, SOFR. It's the secured overnight funding rate. LIBOR will be replaced at the end of 2021 by SOFR, the secured overnight funding rate.
Thank you.
Patricia, I agree with what you said. Just getting back to your point, treasuries are considered the safest investment in the world. They're not going to earn you a lot of money, though. Depending upon your investment objectives, it might not matter to you. You might just be looking to park your money, like we see a lot of global investors just park their money in treasuries because it's safe. If you're looking for a more aggressive yield, then of course you really need to do your homework and look for other opportunities. And of course, understanding current events and immersing yourself in the capital markets is one way to achieve that. I agree with you, and that was a good point. So
as well, Professor, you can invest in some, let's see, organizations, I will call like that. What you can get the dividends is like, you know, from the
that's
bank.
right, you can invest in dividend
Yes,
producing
exactly.
stocks. That's
You can
exactly
get
right.
the dividends, and that's what will bring you monthly money.
Right. I was remembering today, back in 2010 and 11, when I had students that were buying Bitcoin. And I'm wondering now if they still own the Bitcoin and how cool that would be.
They definitely don't. They got.
Yeah, no way.
Well, okay.
I don't
Many-
even have patience on the market. I am like trading daily. I do very like aggressive investments.
Okay, so
yes,
let's.
sometimes yes, I lose, but I am learning. I am very new to it. Then it's okay.
That's the way to do it. But you can never, it's like going to Las Vegas. You never want to gamble more than you can afford to lose, especially now as a student, you want to be super careful. So that being said, though, having read some of your chat, some of you are clearly very sophisticated when it comes to the markets, and I imagine are doing some very interesting trading as we discuss as the semester unfolds and we talk more about that, about trading. I will look forward to some input there. If you look at the 10 spread versus the 2 and 10-year spread over the same period of time, you see basically they track one another. During periods of great distress in 2008, we saw the Great Recession. We see that the 2 and 10-year spread went to, I think it was 465, and similarly the 10 spread went up into well above 450, which was historic. We've never seen that kind of volatility in either one of those spreads. Now, if we look here, we're looking at the yield curve in December of 2018. I wanted to show this to you because what do you notice that's different here? You notice that the 3-year and the 5-year, the 3-year is yielding more than the 5-year. Isn't that right?
Yeah.
That was the first time that happened since 2007. Does anybody know what that's called?
Inverse.
It's called the yield curve inversion. Why does that happen? It happens when long-term rates fall below short-term rates. So you've got some type of short-term geopolitical uncertainty that triggers a flight to quality from the short end of the curve to the long end of the curve. And as investors are moving their money into the long end of the curve and buying long-term bonds, what's that doing to the price? It's increasing the price, but what's it doing to the interest rate? It's pushing down the interest rate. So
can you repeat it, please?
a yield curve inversion is a measure of risk, and a yield curve inversion is usually a sign of a recession about to come sometime down the road, generally considered sometime between 10 and 24 months down the road. If you look here again in March of 2019, you see that the 10-year curve, the 10-year Treasury bond was yielding 243. Both the 1, 2, 3, and 6-month Treasury bills were all yielding more than the 10-year. What's going on in 2019 and 2018? We talked about that last week.
Trade war.
Trade war. Trade war. Trade war plus very Trump-specific uncertainty, very Trump-specific uncertainty, very Trump-specific, Trump-driven volatility in the global markets in terms of where the U.S. stands, in terms of trade, in terms of its allies, a lot of uncertainty. And all of this is rollicking the Treasury markets in 2018 and 19. And we see in the summer of 2019, again, we see that the short end of the curve is yielding more than the 10-year, as you see, I point out there. Now, if we look here, what do we see? We see that the inverted yield curve has predicted the past 7 recessions. So here we are in 2019 again, and right over here, we see that the 10-year is yielding below the 2-year. Okay, that was here in 2019. Okay? Okay, and I've indicated for you each of the recessions, and as you can see, the yield curve inverted before each of them. So yield curve inversions are very closely watched, and when they happen, when they do occur, it's a reason for concern. As they've shown themselves to be very good predictors of recessions. Yep, shoot, I'm gonna just step away from it. Yep.
Are these cool? Thanks, man. Is the yield curve a leading indicator or lagging?
The short end of the curve reflects expectations for Fed moves. The long end of the curve reflects expectations for economic growth.
So it's leading?
Right, but the trade war, right, but the yield curve inverted back in 2018. 24 months later is 2020.
Corona wasn't like able to be predicted.
Well, that's of course right. Well, in other words, I think that the inverted curve was because of the trade war. I think that the crisis that we're talking about now, I think that the inverted curve that we saw in 2018 and 2019 were because of the trade war and uncertainty attendant to the Trump administration wreaking havoc around the world in a variety of ways. I do not think that this current downturn is because of the trade war. I think that the impact of the trade war can be identified in a variety of ways, as we talked about last week with the rise in bankruptcies, farm suicides, the need for extraordinary government support of the farm sector, the downstream effects of steel and aluminum tariffs through multiple industries that have affected industries to contract and have led to job losses. So, I mean, yes, your answer is right. You're right. This current period that we're going through is not due to the depth and breadth of this contraction is because of the COVID pandemic. There's no question about that. There isn't, but there's supply chain that's of course affected supply chain disruptions. That's caused tremendous supply chain disruptions around the world. In terms of the trade war, well, the after effects of the trade war are still with us because many of those tariffs are still in place. They haven't all been rolled back. Some of that's going to take some time, and that has all had impacts on the various industries that use the products such as steel and aluminum, imported steel and aluminum in their production processes. So again, I'm walking in a circle, but yes, you're right. This is why I wrote here COVID pandemic. It's and no, it's not. And yes, it's not a result of the trade war. Okay. Anything else on that? Okay. Let's talk about the yield curves. So we have 4 types of yield curves. You have a normal yield curve, which we said the expectation is that the economy is going to grow and that the Fed will eventually raise rates to slow down the economy. That's a normal yield curve we looked at before. Where we are now, well, the yield curve, the spread is about 110 basis points. I think that the spread on the 3-month and the 20-year is wider than that. It's just under 2%, I think. But the yield curve is steepening because the expectation is the economy is going to recover, both with the successful vaccine implementation and with a historically large rescue package. So we have a normal yield curve, a steep yield curve, a flat yield curve. We see that rates are consistent across all the yields, which implies uncertainty about the economy. And finally, the curve we just talked about, which is the inverted yield curve, where long-term rates fall below short-term rates. We see uncertainty triggering a flight from quality from the short end to the long end of the curve. Are there any questions on these 4 curve types?
Could you please go over one more time, Professor, about the 4 types of curve?
Well, so a normal yield curve, you're seeing a slow increase in the yields in the rates that are being paid. As the longer the duration, the more return you're going to get. Do you understand that?
The first one, the normal one, yeah.
Right, a normal yield curve. Well, a steep yield curve is what we're seeing now, which is so that here's a normal curve, and now it's steepening. We have very low short-term rates and higher long-term rates. So the yield curve is steepening. The expectation is that you're going to see growth in the economy, and that what's going to happen is that the Fed is going to be put in a position where we'll have to raise rates later. Yes?
That would be the flat yield curve?
Now that would be a steep yield curve. A steep yield curve is what we expect to see during a recovery.
Oh. Mm-hmm.
During a recovering economy, we expect to see a steep yield curve. When there's uncertainty in the economy, we expect to see a flat yield curve. Yes?
Okay.
When there's fear about current economic events or geopolitical events, we will see an inverted yield curve and a flight to quality from the short end of the curve to the long end of the curve. Okay?
Thanks.
Okay. So we looked at this last week, and we showed that we plotted out the present value formula, and we saw that you can plot the bond price against the bond yield because they're inversely related. We also showed that what happens when the Fed buys. We said that when the Fed buys, prices are going to rise, interest rates will fall, the dollar is going to fall, and that the money supply, the domestic money supply, currency in circulation is going to increase. We said if the Fed sells, prices fall, rates go up, the dollar strengthens, and the money supply is taken out. So depending upon what the Fed targets for the domestic money supply, it can either inject or remove liquidity from the domestic economy. And there are a variety of tools that it can use to do that. And we're going to look at those. So what's the Fed's job? The Fed has a dual mandate, which is maximum employment and stable prices. To meet the long-term and short-term interest rate money supply targets, what can they do? Well, they can raise or lower interest rates. They can buy or sell currencies and securities. They can change the reserve ratios. Can anyone tell us what the reserve ratios are?
How much banks need to keep in their bank, like actually without lending it out?
That's right. How much of cash cushion do banks need to have on reserve? That's exactly right. So they can change the reserve ratios. If they lower the reserve ratios, what does that mean? The bank can lend out more money. Yes, they tighten the reserve ratios, they can't. So they have to lend out less. And the fourth thing that the Fed can do is provide guidance via signaling. What does that mean? It means what we talked about, what we saw last week, when the Fed comes out and they give a press conference and they go through granular detail about the numbers and what the economy is doing and what they expect it to do. That is signaling, okay? Last week when the Fed chairman discussed the Fed's commitment to to its accommodative policy and to its bond buying program and to keeping interest rates low, all of that are examples of signaling. So we know that the Fed has a profound effect on the global economy and influences money and credit conditions everywhere. I gave you here the FOMC Federal Open Market Committee meeting schedule. The next meeting that we'll have is in March, and we'll certainly talk about that. Those with stars simply mean that they come with a press conference and a statement from the chairman, the Federal Reserve chairman. Any questions here? Okay, good. So the prime rate, what's the prime rate? The prime rate is the rate that banks charge to their best customers, their preferred customers. It's published every day in the Wall Street Journal. Right now, it's 325 basis points or 3.25%. It's used to set rates on adjustable rate mortgages, auto loans, credit cards, home equity loans. Again, a critical component to the global capital markets and to the domestic American economy. The discount rate is the rate that the Fed charges banks to borrow money. Right now, it's at 25 basis points or 0.25%. The Fed funds rate is the rate at which banks can lend each other money on overnight loans, which is something they commonly do. The Fed sets the standard rate, and the rate now is 25 basis points.
And
so
this
here
rate
you
by the bank's loans, right? Or
the rate at which banks can lend each other money on overnight loans.
And this is for the banks to overcome any shortages they have in the end of the day.
That's exactly right.
Okay.
Morgan Stanley borrows from Citibank, borrows from Goldman Sachs, so on and so forth. Exactly right. So here you see how it's published here, the prime rate, the discount rate, the Fed funds rate, and the liquidity spread we said is what the bank charges on top of the prime rate in order to make a return depending upon your credit worthiness. You'll see if you have very strong credit worthiness, you're a good client, the liquidity spread will be lower than it would be if you're a weaker client with weaker credit. If you're charged prime plus 500 basis points, which is pretty standard, you're paying about 8.25% for your money. That's how liquidity spread works. We're going to be referring to that multiple times, many times throughout the semester. So an important concept to understand. Again, liquidity spread. The day count convention that we use is 3360. This is the standard method to calculate interest. There's a Swiss standard that's different, but here in our class, we're going to use the standard US method, which is 30 days a month and 360 days per year, and we'll use it in all of our calculations. Now, if you look at the Fed funds rate, you see that the Fed funds rate since the early 1970s has had quite a journey. Yes, and this takes us all the way up to 2000, just about 2016. If you look here in the late 1980s, you see that Treasury rates Treasury rates were as high as 10%. Well, back then, one of the things that you could do, and even back here in the 1980s, although I wasn't really doing anything back then, I was in school, but back here I was working, and we worked on something called the yen carry forward trade. What did that mean? It meant that you could borrow money in Japan at next to zero. Rates were very low in Japan, and you could invest that money in US treasuries yielding 10 and 11%. And what could you then do? What's the arbitrage?
Low the interest rate.
Pay it off.
Spread on the rate. You make the spread on the rate, and take into consideration the exchange rate difference. It was a very profitable trade. That was the yen carry forward trade. You're borrowing yen and investing in high yielding U.S. treasuries. And you see on this chart that the Federal Reserve cutting rates after the S&L crisis in the early 90s, after the dot-com recession, and then of course after the Great Recession. What is ZIRP? That's zero interest rate policy. And beginning in 2008, we see 2007, we see the Fed instituting zero interest rate policy that is in place until the end of 2015, where during a series of 9 interest rate hikes, the Fed funds rate was returned to 2.5%, and then you see what's happened now as a result of the condition of the economy. The Fed has dramatically cut the Fed funds rate all the way back to 25 basis points in an effort to stimulate the economy. Any questions here?
Yes, Professor. Then let's see. I am going buy a house today. Then I will like my interest rate and will be 0% for entire 30 years.
I'm sorry, you would like a zero rate interest?
Yes, it's like right now is a 0% of interest, correct?
Someone's offering you a 0% mortgage.
Yes, mortgage. Then if I buy a house at this moment for 30 years mortgage, then I can lock down my mortgage for 0%, correct?
If you buy a zero, if the bank gives you a zero rate mortgage,
yes,
well then you're paying. What are you paying? You're paying back just the principal?
Yes.
I think she's asked. I think
yes,
I'm sorry.
I am just asking. Yes.
You're asking, can you do that?
Yes, can I do that?
I think she's under the
zero rate mortgage. I don't know of any zero rate mortgages. I mean, sometimes it's something that corporations do for their senior executives. Companies do it. I know that universities sometimes do it for their top professors. Interest-free mortgages. In terms of the domestic capital markets, I don't think so. There are interest-only loans. There are interest-only loans. There are low-interest loans. In terms of no interest, that's free money. And I don't know of any examples of that here in the domestic banking markets. Sorry?
I think she's confusing between the federal rate and the actual rates that
yeah,
well, the Fed funds rates the rate. I'm sorry. Right. Hold on. Pardon me.
Guy, I think so. You right. I might be confusing between these two rates.
Okay.
So
sorry about that. I apologize. I want to
Yeah,
move forward because we only have a few minutes left. Hold on there. Okay. So in our remaining 5 minutes, let's just get through this, and then we're going to break. Zero interest rate policy was a policy in place from 2007 to early 2000 to mid 2010, where keeping interest rates low was meant to encourage firms to borrow and spend. What's a liquidity trap? A liquidity trap is when you keep interest rates so low that they don't stimulate the economy. What's the solution? To expand the money supply via quantitative easing, which the Fed did in those years, 2007 to 10, and more than 2010, 2012, of roughly $4.5 trillion. It's large-scale asset purchases through open market transactions where the Fed comes out and says, as they did the other day, we're going to continue with $80 to $90 billion in bond purchases every month to keep interest rates low. As one of you pointed out earlier in tonight's session, one of the byproducts of the Fed's moving in that direction is the fear of inflation. That's called cost push inflation. The anticipation of inflation that encourages or galvanizes consumers to shop now is called cost push inflation. Okay, so that's a liquidity trap. And you see here quantitative easing during the Great Recession between 2008 and 2012. The total of all of this was about $4.5 trillion that was added to the balance sheet, which is greater than what we saw in the what we've seen so far in the during this pandemic, but we're not quite over yet, and we expect some big numbers coming out of the Biden administration. I'm going to stop there. I'm going to stop there, and I'm going to post all of this for you on Blackboard this evening. Sometime in the next hour or so. I have posted for you on Blackboard some summary sheets on the Treasury yield curve and the Fed on the Federal Reserve. We haven't gotten to everything on the Federal Reserve tonight, but if you take a look at the sheet I posted, you'll be up to date on the on some of the additional tools that we're going to talk about with the Fed on Wednesday. Beyond that, are there any questions for me? No? Okay. I want to thank you all for a very good night. I wish you a good, safe continuation of your evening and a safe day tomorrow. And I look forward to seeing you again on Wednesday. Thank you for all of your great comments, and good evening. Bye-bye.
Good
Thank you,
night.
Professor.
Bye-bye.
Yeah,
Right.
Professor.
Bye.
Thanks, everybody.
Bye.
Bye. Thank you very much.